if my husband was the person who had booked a meeting with a finance professional, it was mind blowing to me how many finance professionals were willing to assume that I was an easy mark. I had one experience where a group of 4 male investment managers tried to assert to me that there was no such thing as a publicly traded real estate index. And like I had literally traded that index when I was at Goldman. So I had a really very entertaining few minutes, kind of like asking some questions
Oh
because
my gosh.
at first I was open to giving them the benefit of the doubt, right? That maybe there was a miscommunication or maybe they hadn't understood what I was asking for. After, like the 4th follow-up, it becomes real clear that like if they were playing with any level of integrity, they would have answered my question. And I said, oh, it's really funny that you guys like don't know about publicly traded real estate indices because I remember trading and I rattled off a few tickers like, when I was in a multi-strategy hedge fund at Goldman Sachs. Have you guys ever heard of any of those as investment managers? And it was like a very awkward moment. And then I was like, oh yeah, Bob, did you know what she was asking? Oh no, I'm not sure, Mike. I didn't quite understand. And it was clearly BS, right?
Oh my gosh.
I just
That's crazy.
absolutely. It was just so mind blowing to me. And I was like, man, like you shouldn't need that level of professional credentialization to be able to stand up and get, reasonable answers to reasonable questions.
If you've ever wondered why certain women want to work with women, that story is a prime example. I'm not hating. I am not hating. I'm just pointing out facts here. If you're a woman who appreciates being respected and believed and advocated for, this episode and all of the Grown Ass Woman's Guide episodes are for you. I'm Jackie McDougall, and this is the Grown Ass Woman's Guide. If you are ready to show up for yourself, take care of your shit, and step into the peace and joy that is living a grown-ass life, welcome. You're in the right place. Wallis Tsai is a finance insider turned industry disruptor. She brings a quantitative, no BS approach to insurance-based wealth planning and risk management. As you heard earlier, she's a former Goldman Sachs investment banker and hedge fund investor. But it was when she was shocked by the misinformation in the insurance industry that she founded AboveBoard to provide transparent, analytically driven insurance solutions for affluent professionals, high net worth families, and fiduciary advisors. The thing about Wallis is that she is brilliant in helping us prepare for all of life's unexpected twists and turns. But for many grown-ass women, we wait for life to take a major hit before we do something.
Oftentimes, clients come to us after they've had direct personal experience with such a tragedy. So, for example, we had one client who found us because she wanted to get life insurance and disability insurance after her husband sadly had been diagnosed with terminal cancer at a time when neither one of them had that coverage. And so unfortunately, it was too late to get him covered, but they were talking about it as a couple and they had young children at home and they said, okay, we have to make sure that this doesn't happen with her, right? Because they knew based on his diagnosis that she would become a single mom. And, he survived for less than a year after that diagnosis. And, these were two really bright, professionally successful, well-educated individuals. And, sometimes life gets busy and you don't get around to taking care of the stuff that, you should, but there's always something that's a hair on fire problem in the moment. And oftentimes things like life and disability insurance don't reach that level of urgency unless you have some sort of horrific reminder like what they experienced, that it is really important to do. That was an example where we could only help one of them at that point, which was really unfortunate. But other times people come to us because they're like, I'm 38 and my best friend from college just got diagnosed with stage 4 breast cancer. I need to get on this. I have a 3-year-old. I haven't done it. What should I do? And so I think that trying to kind of think about those awful scenarios is not pleasant, but
it's reality.
Yeah. And I think that if it can kind of give you the strength and the energy to decide, I am going to take care of this, like it's really valuable.
So we got to know, is it too late in our 40s, 50s, maybe even 60s to get life insurance?
No, not at all. In fact, as a woman in my FDs myself, I'm always happy to share that in the scheme of insurance, honestly, we're young. So
Great.
there are a lot of clients in their 60s, 70s, and even for some carriers, they'll go beyond 70s. I would not recommend waiting that long. Usually the people that are doing that type of planning are doing it for estate planning reasons. Yeah, in your 40s and 50s, life insurance is very much available, barring some of those situations where somebody's had a really significant health event already. But even then, it can be worth exploring because people are often surprised by just how many levels of insurance there are. And so, like, we've got women insured who survived a heart attack within the past 5 years, right? And because we work with so many different carriers, we can go out and see, like, is anyone open to this person? And you only need one, right? Like, we work with about 30 carriers, and even if, a bunch of them come back saying decline, 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 if you get that one that says, oh, we could do this, right? If that works out, that's all you need. And there are also some cool things you can do in terms of group planning. So you mentioned that you're a business owner yourself, and for any listeners who are business owners, or even members of management teams at companies that are kind of, I'll call it, small enough to be a little more nimble, right? So like if you're working at, JP Morgan Chase, like you probably can't just raise your hand and say, oh, I'm a senior executive in the commercial bank, like I need this benefit for myself. But if you're at like a law partnership, that might be totally possible, right? Like where you could run the benefit through the workplace. And that can sometimes allow us to get people who have, I'm thinking of two clients right now, they have active cancer diagnoses because the manifestation of that cancer is such that they're going to work full time, they're living good lives, right? We were able to get them coverage in a completely above
Wow.
way. Yeah.
Wow. And now when you talk about being able to get coverage, that's great.
Mhm.
Are they going to pay like through the nose for that coverage because of their illness?
No, not for those two examples I was talking about, because those were done through executive benefits plans where it's like a group of, say, 17 senior executives at a mid-sized company. For those types of programs, you can often get no underwriting for a certain amount of coverage. So no underwriting means that they don't ask you any questions about your health or lifestyle history. And an individual medical background is not considered beyond just maybe some basic questions like, are you actively at work full time? Meaning that as long as you're not already on disability leave, you could say yes. That needs to be done in a group level. There's no individual coverage that works that way for any significant amounts. Can I share with you kind of a cool hack for executive women?
Yes, please.
So you asked about pricing and whether coverage is still available in your 40s and 50s. And it absolutely is. And the life insurance rates are still quite reasonable. Where you start to see it get more expensive in the 40s and 50s, especially for women, is with disability insurance. But there are a lot of carriers that will run programs where if you even get two colleagues at the same company to apply at the same time as you can unlock discounts that are between 20 and 40%.
Wow.
Yeah, no, it's really amazing. And so some of our executive women clients could even like give the gift of coverage to two of their like assistants or analysts and be like, let's get this started. I hope you'll continue it. But up to you. And the savings for them are so huge that it makes sense to do a group. So that there are ways you can address some of the challenges that come from first getting coverage in your 40s or 50s. At a high level, you want to make sure that you're replacing the paychecks and or care that you provide for free for the people who depend on you for as long as you expect them to depend on you. That's kind of the first order of business. And if you've done that, then the odds that you've averted financial disaster if you encounter a health crisis are really, really good, right? Because even though it would still be personally really challenging for your loved ones, if those future paychecks or care that you provide for free are fully funded by the insurance, and that makes processing all the other trauma that comes with a loss or a serious health diagnosis just much easier to weather. So that's like the disaster prevention use case for life insurance. There's other stuff you can do with respect to retirement readiness, which is a really big topic in the 40s and 50s, right? Because you're kind of starting to like see land maybe on retirement, or at least think about it. And then there are other use cases for life insurance with estate planning. But if the top priority is averting disaster, then you just want to start by making sure that future paychecks or free care provided are covered.
Okay, so we know we need life insurance, and today we're going to get into the nuts and bolts. But how do we know who we can trust? What are the red flags?
Yeah, so my red flag warning would be that if you ask reasonable questions and struggle to get answers, that is usually a red flag warning. And so, a reasonable question might be like, hey, like, could you explain to me like what company you work for and which carriers or insurance companies you regularly sell policies for, right? Like that's a reasonable question.
Yeah.
And even if somebody has sort of a non-answer to that question, that would be concerning, right? Because everyone in the business like kind of knows how they operate themselves. Although I have heard stories too about like clear misrepresentations being made, where people who work for one particular company will represent themselves as being independent. But the way that it really works is that they're paid like 2 to 3 times as much to sell one company's stuff. And then if that one company rejects an applicant, they're allowed to take the business outside. And so you can get pretty granular. If the person has a website, oftentimes like at the bottom of the website, there's information about how they're set up. And then you should also just ask questions, until you feel like you really understand their situation. And I think that the other thing that can be a good clue is when talking about what type of policy to apply for, asking them things like, what health class is this? Like, why do you think I would qualify for that health class? And then this is like a little bit jargony, but that word is health class, because with insurance, there are different levels of pricing. You'll hear them called health classes or underwriting classes. And one of the traps sometimes is that people are just, some professionals will just show either the best health class or the second best health class to anybody. Oh. And so we've had some clients where they come to us, answer the health questions. And for example, somebody, survived, prostate cancer 7 years before, right? And there are some nuances to that situation that like not every carrier would price well, but some carriers would price well. And so we've seen that sometimes that person gets quoted the best tier of pricing and they're like, oh, well, why is it this way elsewhere? And we can explain to them that that's not really a realistic quote. But I think the question when you're shown a life insurance quote is always like, what health class is this? Based on my health history, why, do you believe I would qualify for that? And if you're somebody who has some real nuance to your health history, a good follow-up question is, have you pre-cleared me with the underwriting department? Right? Oh. Sometimes the dance can be like luring people into a big application process.
Okay.
Much worse pricing for reasons that were totally knowable in advance, right? There are legitimate surprises that come up, right? Like if somebody has no idea their cholesterol is high and then on the lab results, they just happen to test really, really high. Surprises happen sometimes, right?
Right. But, so then the price changes based on those results.
Yeah. And even in that scenario, though, the way that we'll handle it is that there are some different standards between carriers. And so like we had one client where there was a typo in her medical records and it said she was a hoarder. And it was totally false. And so her therapist was one.
Okay. We have to sit for that. I was sitting here trying to go like, what would they be trying to say if it's a typo?
Actually, we used that Milliman and Telescript report, the consumer report for your prescription drugs, to figure out that the diagnosis code for hoarding disorder is actually one keystroke different from generalized anxiety disorder.
Oh my gosh.
Generalized anxiety disorder is one of like the mildest diagnosis codes you can have to still have a chance at health insurance covering talk therapy. Very common, right? A lot of people do that. Whereas hoarding disorder is a more unique situation and in the eyes of insurance companies, more serious, understandably. And so there's this one keystroke difference at a single appointment. And so it kind of looked like, oh, for years, this person was doing talk therapy for generalized anxiety disorder. And then at one appointment, they were treated for hoarding disorder. So we figured that out from the Millen report. We went back to the carrier and we were like, come on, like this is obviously a typo.
Yeah.
And that carrier was like, no, we think she's a hoarder. And we're like, really? Like, how does that make sense? And they're like, it says hoarding. We're like, the therapist will write a letter saying she's not a hoarder. They're like, we don't care. It says hoarding. And so what we did is we went to a different carrier that was like, oh, that's funny. That's a typo. We're like, yes, that's correct. Let's do business with you.
So what kind of access are we providing these companies to look at our health? Is it like every single appointment we've ever had since the beginning of time?
So the short answer is theoretically, yes. They reserve a right to require anything that they want to see. So for any individually underwritten coverage, right, which is when you as an individual human apply for coverage from a company, right? So not through your workplace. But when you apply for any individual coverage, that's standard, right? Like to get well-priced coverage, you basically have to authorize them to take a look. And they can go out and look at information that's easy to access. There's this Milliman and Telescript report, which is kind of like a credit report, but for your prescription drug history. That's a quick, easy thing for them to pull. There are some other similar services they might use. And what they'll basically try to do is triangulate, does what you're telling them about yourself look well aligned with what they're able to see easily? And then they may or may not choose to pull your full medical records, but they do technically have a right to really require anything in your medical history. Definitely representing yourself, we always say, in the most favorable light, truthfully possible. Something that we focus on doing with clients because that can help you get the best coverage that's available to you.
Insurance policies can have a variety of terms. So how do we know which length we should go with?
So it really depends on what you want the insurance to do for you. If the only goal is to replace future paychecks, if God forbid you died before retirement, then term insurance is pretty much always the best tool for that particular job. If you want your insurance policy to provide something else, for example, tax advantaged retirement savings, right? Let's imagine that somebody's in a situation where they're already taking advantage of the 401k match they have. Savings are growing pretty well, and they still have some money left over each month or year that they'd like to invest. That's the sort of situation where looking at permanent insurance can start to make sense. Have you ever heard that adage, buy term and invest the difference?
No.
It's a really interesting thing. And this is kind of a wonky insurance thing, but I think it's helpful for people to understand. So whole life is actually one type of lifelong insurance coverage. So if we think of a term as temporary insurance coverage, right? Like if your goal is my family would need paychecks replaced if I died before retirement, term will do that. Now, on the other side of the house, there's permanent insurance, which is coverage that's designed to last your entire life. And if permanent insurance is like ice cream, whole life insurance is like saying mint chocolate chip. And there's other stuff like variable life insurance, which might be strawberry, or universal life, which might be like chocolate, right? So that to keep the analogy going.
So different flavors of insurance.
Yeah. And which one is right really depends on like what you're hoping the insurance will do for you and what goals you have. So for goals like retirement savings, you generally want that type of policy to be from the permanent side of what's available in insurance. Or if you're doing estate planning where you're hoping to leave something to your loved ones for after you're gone, permanent insurance is the right tool for that job.
Okay, because by the time you pass, the term might be over and then there would be nothing to leave behind.
Exactly. Term is really designed to be temporary, where like the need for the insurance is expected to go away at some point if you live a long time.
So term insurance, when the term is up, nothing is paid. So if the term goes until you're 75 and you're still alive, congratulations, but there will be no death benefit.
Yes. So if you outlive your term, then that's exactly right. And that's often okay. One of the sort of BS lines in the industry is like, why rent when you can buy? And the idea is that, renting is like term and buying is like permanent. And that's often not the right way to look at it, because if your goal is just to replace money earned if you die before retirement, then if you live long enough to retire, that need has been addressed, right? And so what I often say about term insurance is that it's a little bit like homeowners insurance or auto insurance, where you actually buy it hoping there won't be a claim.
Right.
Right? Like your goal ultimately is to live a long, healthy life, which includes living to retirement for most people. Oftentimes people want to feel like, okay, well, even if I am still working for fun, I don't want it to be that I have to work, right? And so in that situation, term is a good tool for the job. And term is a lot less expensive than permanent, because the way term is priced, if you're able to qualify for it, meaning an insurance company is willing to offer you that term policy, it's because the insurance company believes that you're very likely to outlive it, right? The term policy really is just disaster protection against dying young. Whereas for permanent, the insurance company is, not confused about the fact that at some point they will need to pay a death benefit with a permanent policy. And so that's the reason why the premiums on average are, call it 6 to 10 times greater for permanent coverage versus term. But, if you have other goals for your insurance, like supplemental retirement savings or passing something on to future generations or organizations you care about, then that difference can totally make sense. And the right way to think about that choice is basically doing that analysis of well, what would it look like if I only used term and invested the difference, right? Because the term is much cheaper than permanent. And so if I take that difference and put it somewhere else, how does that money grow for me? What does it look like in 20 years, 30 years, whatever time frame you feel is most important? And then, compare that to an insurance policy and ask well, which looks better, right? Which looks like the right tool for the goal that I have.
So let's stay on the term versus permanent insurance thing for a minute. So we know with term that the premium you pay is directly connected with the potential death benefit. So if you're looking for $50,000 in life insurance, you're going to pay a lot less than maybe somebody who has a $2 million policy. But what does permanent look like? Wallis says we start with a death benefit amount, but that amount can actually change.
You do choose a starting death benefit, but then with permanent insurance, there are more choices you have about the way that your policy is structured and how it might grow over time. So for some permanent insurance policies, it's just a fixed number, but it lasts your whole life. For other permanent insurance policies, you might be able to allocate some of your money that you put into the policy to, say, the S&P 500. And if the S&P 500 goes up, your death benefit goes up too. So there are different ways you can design the policies based on what you're trying to achieve. With a lot of those permanent policies, they do have something called cash value. And cash value is the amount of money that the owner of the insurance policy can access while they're still alive, while the insured person is still alive. And that cash value is what can be used to help finance retirement and provide benefits while the insured person is still living. And so that existence of cash value is one of the useful things about permanent for some goals. Term policies do not have cash value, right? They're just there for the death benefit, whereas permanent insurance policies often have cash value. Not always. Some of those are designed to just be only death benefit, but lasting your whole life. But many of them do have cash value. And so in that situation, to your question, the basic mechanic that when the insured person dies, their loved ones or beneficiaries, or what they're called on the policy, they get the death benefit. But that's not the only thing. You can also access the cash value even during life. But I think a key question to ask to decide if term or permanent is likely better for you is, what is the main goal of my getting life insurance at all? And if the main goal is to replace future paychecks or care you provide for free, then term is almost certainly either the right answer, period, full stop, or it is a good component of the overall strategy, right? Because sometimes we have clients who, maybe at 45, they're financially in a place where they're looking for some supplemental retirement savings, but they also have some kids at home still. And oftentimes when you do that analysis, if you sort of start with the question, is the amount that your loved ones would need different if you died next week, say you were hit by the proverbial bus, right? Is the amount of insurance that would be needed different if that happened versus the amount of insurance you would want to have if you retire as a healthy 67-year-old, right? And oftentimes the answer is yes, right? And so that's how you can kind of start to think about, well, is term or permanent most likely right for me? And if you're trying to do something like supplemental retirement savings or planning a legacy for future generations, that's pretty much always going to be permanent. The reason you might use some term there is if you're not sure if you're ready to go for it now, or if you're not sure how much you want to do. Because term policies do have, most of them, I should say, not all, but most of them have the right to switch some or all of your term coverage to permanent coverage without having to prove you're still healthy, which can be hugely valuable, right? Like if you think about a scenario where as a healthy 40-year-old, somebody decided to get some extra term, they chose 20 years thinking that would be enough. And then at 59, they were diagnosed with stage 2 colon cancer, and they're hopeful it'll go well, but they just don't feel great about having their term coverage expire in a year. Most of those policies have some mechanism for converting term to permanent. They're called conversion options because you convert from term to permanent. Importantly, like there are expiration dates on those conversion rights, right? So you might have term where if you had converted a few years ago, that would have been okay, but now you can't. And then also the carriers differ in that some of them let you convert to really nice product that healthy older people would be happy to buy. And other carriers say, hey, if you want to convert, you can buy this one thing that we have, and it's not very nice and it's kind of expensive, right? It's like a really different choice. But that's another dimension of thinking about that question you asked about term versus permanent. That you can start with term and end up with permanent, but you might want to be real careful about which carrier you pick, which we help all the time.
And so if somebody were listening right now and they were like, there's a lot of information here, like what is one thing that you think everyone should know about life insurance specifically?
I would say that you want to really think about the people in your life who depend on you. And if, God forbid, you were hit by that proverbial bus tomorrow, if financially the loved ones that you see around you would be in a bad situation or a very different situation from how they are today. That's like something you really want to reflect on. And even if you did that analysis, say when you were expecting your first kid, right, it's good to refresh it because life changes. And so you just want to make sure you keep coming back to that question every few years and make sure that you're set up in a way where if, God forbid, that happened, the people you care about most would be okay financially. One thing I would mention about life insurance, which is a very common mistake that we see, a lot of people think they're covered at work and they either aren't very well covered because the amount is just way too small, or the price they're paying for any workplace coverage that they choose to pay extra for is really high. I mean, the number of people who think that their workplace coverage that they pay for is inexpensive is really high. And I have seen that actually be true like literally 0% of the time. Even like major corporations, even like the program that the federal government uses, those rates are quite high, especially if you look out at how they increase over time. Because the common workplace life insurance pricing plan is that as you go up in age, the premiums go up too. And so it can feel like really like cheap and not a big deal when one is younger, but it really starts to bite as you get into like the late 30s and 40s. And it's just like a hockey stick afterwards. It's really bad news. And so you want to try and get off of that while you still can qualify for something better. And like, to give you an example, we've gotten people who survived heart attacks a few years before covered at rates that are lower than their workplace plan. So if you are relying on workplace coverage, it's very unlikely that that's your best deal.
That one hit home for me a little bit. We assume that the workplace coverage is the best deal because it comes from our employer. But Wallis says that's actually almost never true. Because what happens if you lose your job or you leave there and you haven't set up coverage anywhere else?
Yes, that is absolutely a concern, because most of those workplace life plans are not portable, meaning you cannot take them with you. And then even the handful that are, they're portable only on the worst terms possible. Very expensive, little benefit, or both. And just the rates on that term coverage that you pay for, right, where you check the box on annual enrollment that you want, 2 times your income, 6 times your income, whatever it is, for the vast majority of people, you can qualify for better rates in the individual market and not have to worry about whether you lose your coverage because you lost your job.
I gotta admit, this episode was a lot to take in, so I created a cheat sheet to help walk you through it. You can get the link right here in the show description. Wallis will be back to tackle 2 more very important topics, disability and long-term care. So make sure you are subscribed so you do not miss a thing. We're tackling all the grown-ass topics and hopefully making them accessible and easier to digest. And Wallis has set up a special webpage for us grown-ass women at AboveBoardFinancial.com/grown-ass-woman. So definitely check that out. If this episode was useful for you, please share it with a woman in your life who needs to hear it. Because one of the most grown-ass things we can do is look out for each other. I'm Jackie McDougall, and this is the Grown-Ass Woman's Guide. Thank you so much for being here. Until next time, remember, you are a grown-ass woman. Act accordingly.